think we're live. I think we're live.
We are live. We
Yeah,
are
yeah.
live. How about this? Okay, we are live streaming. Welcome out there in what internet land. I'm Dave Shikavich. I am the president and founder of Carolina Retirement Planners, and with me here is my daughter Sam Shikavich, partner in the business, and we are coming to you as we have now for over 2 years on Thursday at 4:30 with our happy half hour, where the idea is get together for half an hour, grab your favorite drink, and we'll hopefully bring you something educational, but still reasonably entertaining. And what is our topic today, Sam? Do you remember?
Yeah. I mean, it's right behind you as well. But today we're going to be talking about mutual funds versus ETFs. What is each one, and what's the difference between them?
A lot of people, can kind of get confusing. The world, the industry throws those things around, and I thought we'd give some background on them and the advantages and disadvantages and some of the stories behind them that get kind of interesting. But as usual, we are not here alone. Behind the scenes is the person who makes it happen.
The ever fun, the smiling.
Our director of client fun. She is here behind the scenes getting all these things working. And it's also, we also like to each time talk about what day it is. Almost every day has something. What is today's about, Sam? Or Amy, what's today's
It's Serendipity Day. It's a very happy day. It's Serendipity Day. Plus, it's just a fun word to say. Yeah.
Is it serendipitous that Serendipity Day fell on a Thursday, so we get to celebrate it?
It is. Oh my gosh, it really is. I think I'm turning red because it really is. Why would I blush over that? I don't know. Yeah, I love it.
Did we put out a question to the audience for Serendipitous Days?
Yes, I did. And we had some really
anything good.
We did. We had some really good stories. I sent them to Sam. I could pull them up really quickly, but you're gonna have to give me a second. But there are some really good ones.
One was a happy surprise of I had to read this a few times, but to understand exactly what was happening. But to condense it down, a happy surprise was Miranda, her Yorkie apparently serendipitously coupled with her son's Yorkie. And it was a shock after she had some sweet little Yorkie puppies for them to love.
I love that.
Any of them serendipitous, you could name at least one of them. Now that's serendipity,
That definitely is. That is good. Yes.
I guess.
Yeah.
I always like to say, I actually had something similar to that story. Well, I'll just be really quick with this. We have French bulldogs. We went on vacation. They weren't fixed. We rescued one and kind of rescued the other one. They had a party while we were gone, and we ended up with 7 little puppies. So that could
we have a really cute picture of that in the back wall here in the office, all sitting on
of the puppies, not the party.
Yeah.
They are sluts. Yes. Yeah, Yeti is a result of that. We ended up keeping Yeti because she was deaf. So yeah, that was a little serendipitous. Not at the time, but later in life, I was like, oh, look at that pleasant surprise. So yeah, it was a little pleasant surprise. So that was a little happiness.
Okay.
But, yeah. Oh wait, what are you drinking? We didn't get to what you're drinking because I have a fun beverage today.
Oh yeah, you do.
Yeah.
Amy, tell us what you're drinking.
I thought I kept the can, but I'm drinking a mead. I'm drinking I don't know what I did with it. Oh, I threw it in the trash. Here. Wait.
No bees were harmed in the making of that mead.
Yeah.
A mango sorbet mead.
No, I poured it in my fermental cup, which we all know I won't finish, but it is a mead. So yeah, that's fancy. We'll see how that pans out today.
Herbal tea.
Okay, now I'm getting back to work. Okay.
I didn't even get a drink. I failed.
Variety, highly overrated. And I see today Bruce is with us and Brad.
Yeah, I gotta get back to work. Bye.
Barb is with us and says that she's back in the mountains, but her husband Dan is now at his hunting camp. It's getting close to that time. And Barbara says hi to everyone. I noticed that the
Barbara.
ads I'm getting from Sportsman's Warehouse are like all hunting gear, even though I'm still fishing. I don't really hunt, but you think fishing season is nowhere near over. It's kind of just start to getting good again, you know, but what are you going to do? What are you
I've
going to
seen
do?
pictures of Barb's house, and they have a bear, and they like to dress it up. And I'm really fond of that bear named Bear. Yeah, I like that guy. He seems pretty fun. I'd hang out with that guy.
Mm-hmm.
I don't know if Dan got that bear or not, but I don't know. He seems like a pretty cool bear.
We may want to move on with I don't know how long this is going to take, so we may want to move on here with our little presentation. See if I get. There we go. Get my act together.
I do love how fancy your board looks. Looks very nice and neat.
I know, we can tell that you
God.
didn't write it.
Yeah, well,
Exactly my
yeah.
point.
As many of you know, we have a new director of First Impressions. Jennifer joined us a few months ago. Jessica, and she is she does a great job. I actually have her do the boards as much as I can. So
And a lot of the PowerPoints too.
And a lot of always dresses the PowerPoints up. So you know, we're going to talk about mutual funds versus ETFs. In fact, hey, anybody know what ETF stands for?
Exchange Traded Fund.
That's right. It stands for Exchange Traded Fund, which of course explains it all. I mean, knowing that, it's self-explanatory, right?
Obviously.
Okay, so
presentation over.
So kind of the battle between them, but let's kind of go over a little bit of the history, why these were developed and how it all happened and some of the things. And I want to go back in time to 1929. And you remember 1929 was the big market crash, right? And hey, Sam, did many normal citizens lose any money back in 1929? And did they lose money in the stock market?
Actually, not that many people were. It wasn't very prevalent to be invested in the stock market back in 1929, right?
Yeah, I think it was like less than 10% of people were invested in the market. Then stocks were mainly for rich people, you know, and most people just had money in the bank. Now, the bad news is the banks had a lot of money in the stock market. They lost it all. They crashed. There was no FDIC, and people lost money, and the money they put in the bank would kind of inspire the FDIC and all back then. But you know, back then it wasn't common for people to buy that many stocks. Now, 1974, besides being the year I graduated from high school, what else happened then? Do you know, Sam?
Oh gosh, no, I don't. You didn't prep me for this one.
Okay. 1974, we started the IRAs.
Okay.
Individual retirement accounts. The law passed where you could put money into an account before paying tax and grow it there tax deferred. It was a great place to encourage savings. And now all of a sudden there was a big demand to get more money into these accounts and buy stocks. And in 1978, besides being the year I graduated from Cornell, was the year where they started 401ks. 401ks are kind of like IRAs, but they're with your company. So you don't even have to write a check and send it off to the account. You can just have your employer take the money right out of the market. I mean, out of your paycheck and put it into the 401k in the market. So there was a demand for people to invest in the stock market. Now, if if you want to buy some stocks, if you want to invest in the market, should you just buy one or two stocks, or should you invest in a number of stocks and spread the risk out? Which is better?
Oh, definitely the second one. It's always good to be diversified. You don't want to have all your eggs in one basket, right?
Yeah, so how do you do that, especially if you're starting out with just a little bit of money, putting $50 away a month? And that's where the mutual fund was created. And it actually, the first mutual fund, for those of you who want to get some history, was actually started in 1924. And it was started by what was the Massachusetts Investor Trust. And you see this fancy looking building. That is the current building for the still existing Massachusetts Investor Trust.
That is fancy.
Wow.
Yeah, boy, it is a real, and the first mutual fund they started is still in existence. Its little stock market code is MITTX. It still exists today, and all these years later. However, what's interesting, I think it raised like $14 million between 24 and 29, and it lost 81% of it in 1929 when the market fell, but it did come back. But still, there wasn't as big a demand until 1974. And if you think how a mutual fund works, is someone creates a fund, and you have all these people out here like you and I, and we put money into this fund, and in this fund they buy lots of different stocks and bonds, and depending on the fund, and they hire some really smart person to figure out what to buy. Managers run these funds and help figure out what to buy. And that was the kind of the creation of the funds. And the IRA was a big demand because you were looking to buy, put a little money in, but get diversity. And one of the 401ks, by 1983, about over 50% of the big companies, and it's like 7 years, 50% of the big companies had all started 401ks. And so there was a big demand to put money in, and mutual funds got sold more and more and more. It's kind of interesting because the guy passed the law for 401k said he didn't do it. He did it for the worker to save. He didn't do it to make the Wall Street rich, but it sort of turned out that way. So we had these cases. Now there are some advantages and disadvantages to mutual funds, and let's kind of look at them. One is the advantage is it's diversified. I have a fund that I can get a lot of different stocks in there. I can get professional management and everything else. I don't have to try to figure out what stocks to buy myself. And the other thing is it'll take small deposits. I can put $50 in a month, and that they'll automatically distribute among all those different stocks. But boy, there's a lot of disadvantages to mutual funds. We ourselves, with some exceptions, are not big fans of mutual funds. One of them is a mutual fund's like a black box. You put your money in, you're never quite sure what's in there. They only have to tell you what they own twice a year. In between there, things could be happening and you don't really know what it is. So there's sort of and it's not really transparent. Another problem is fees, because you're hiring this manager to manage it. They're charging fees, and there's trading fees and all kinds of fees. Like even when you buy a mutual fund, there's 2 or 3 different flavors. One of them, you pay 5 or 6% when you buy it, and then 0.5% a year or something going on for each year. Some of them you pay 1% or 1.25%, no upfront fee. Some of them you pay a lower fee, but if you quit early, they charge you a fee. There's all lots of fees. And in the trading in the funds, there's fees that you never see, you never can figure out what it is. And then who they hire to trade for them, there's a lot of stuff goes on there. I won't get it, but the real problem with most mutual funds is fees. Couple other big disadvantages of mutual funds. One is if you buy or sell a fund, it doesn't happen till the end of the trading day. So if at 11 in the morning you say, well, I like that fund, I think I'll buy it, and you put in a buy order, you don't know what you're going to pay for it until the market closes in the afternoon. So that's a disadvantage. The other thing is taxes. If you have non-IRA money, just plain investments, in a mutual fund, you could get charged for taxes. You can find a year where you didn't buy or sell anything, you lost money in your fund, but at the end of the year, you still get a bill for taxes to be paid.
How are they going to be taxing you? How do they know?
How do they tax? That's a good question. You often wonder, well, how did I get a tax bill when the market fell? Well, here's an example. Here's kind of how it works. Let's just say you have a fund and they got a whole bunch of stocks in it, right? A whole bunch of stocks, and it's been a bad year. And let's say 80% of the stocks fell and only 20% of the stocks go up. Now you all kind of share in this fund together, the way it's structured. Now, one of the people that are investing in this say, boy, I'm out. I can't take it anymore. I want to sell my shares of this mutual fund. And so they call up and they say, sell my stuff and to get their money. Now, over here is the manager, the real smart manager. He looks at the funds he has in there and he has to sell something to make money for the people that cashed out. Now, if you're a manager and the market's down for 80% of the things, up for 20, are you gonna sell the losers knowing that they're down and it'll probably come back up if you wait? Or are you gonna sell the winners because they've already made their money? Which one would you sell?
Oh, I know where you're going. Oh, snap. Yeah. So they're going to sell the winners, right?
You're going to sell the winners. Now, if you sell something that's gone up in value, what does that generate?
Taxes. Well,
capital gains.
I know what you're saying now. I understand now. Oh, snap. Sorry.
Capital gains. And that capital gains get taxed. But see, the way this works is the capital gains don't just go to the people that cashed out. They're spread among everyone evenly depending on how much they have. Everybody shares in it. So there is a place where when people cash out of a fund where most of it has fallen and the total value's down, because they sell the winners, you can still get a tax. That's one of the crazy things. Now, a couple of things happen. One is in 1976, a guy named John Bogle, he started what fund?
Or he started Vanguard.
Vanguard. What he said is, instead of trying to pick the winners and the losers, we're going to go look at something like the S&P 500, the 500 biggest stocks in the country. We're just going to buy the proportion of each, or the equivalent. We're just going to ride that S&P up and down. We don't need experts to do it. We can have a computer in the basement doing it. And so they had really low fees. And he also found out that 90% of the mutual funds out there don't, over a 10-year period, don't do better than the index that they're trying to beat. 10% do, though. We'll come back to that in a minute. So John started that and became very popular, and a lot of money moved into them. But you still had the problem, end of the day, and taxes. You didn't get away from that. Well, in 1983, after 6 years of hard work, this gentleman, Nate Most is his name, he was a physicist. And he looked at this mutual fund business. He says, man, there's got to be a better way. And he figured out how to make a mutual fund now where instead of, it has all the stocks in it and all, but instead of acting like a mutual fund, end of the day taxes, it acted more like a stock. You know, if you own a stock, you can sell it anytime during the day, and you don't get any taxes till you actually sell it. And he created the exchange traded fund, and that's what it does. He started something called the SPDR. You might have heard, you probably heard that term. It became the SPY, SPY. It was an S&P 500 ETF. And SPDR, for those of you who are trivia people, it stands for Standard and Poor's Repository Accounts. And really kind of had a lot of resistance. Even Bogle said, no, this won't work. And now Bogle's using them all the time, more than he's creating more of them than the old indexed funds that were mutual funds. So another interesting thing about Most, the guy, is he didn't believe in retirement. He worked up, when he was in his 80s, he was still getting on planes going around pitching ETFs. So a little bit more history there. So what the ETF does, first, it's now transparent. So we get rid of the black box. You can see it anytime. There's usually very low fees associated with them. You can buy or sell it during the day, and generally you don't pay taxes until you actually sell the things you bought. So it got rid of most of the disadvantages of this, but you could still have diversification and small deposits. So
wow.
Now it's not. You might wonder why people are still using mutual funds. Well, there's two reasons. One thing is there are some mutual funds that are outperforming the market, and it's usually in little niches. And like, for instance, one of the investment groups we work with, Sterling, have an elaborate process when they go look to invest. They can look at an area they want to invest in, S&P 500 emerging markets bonds, and they have a way to sort out and find the 10%. Do they have somebody in there that is 10% that's doing better? And it's usually in things like bonds or emerging markets where they can find it. S&P 500, they always use index funds because nobody can beat the index fund and make their money back up. But there's another reason, and that's because mutual funds, these fees are shared with the broker. In the world of investing, there's usually two groups. There's the brokers, the stockbrokers, who make a commission on a sale of a stock or bond, or if it's a mutual fund, they get fees from that fund every year. And so they're biased to sell mutual funds, and sometimes biased to sell the one that are most profitable for them. American funds, for instance, are often seen because American funds actually have a bigger revenue sharing. They give more of the fees they have back to the company that sold it than others. So there's a big bias there, and that could be a seminar, a happy half hour all in itself. But so that's a little bit about that. But largely, much of the world is moving more and more into ETFs because they are a better mousetrap. They are a better mousetrap. And that's kind of the explanation here. And if I can get the power back on, there it is. I thought I'd talk about one other thing in the minutes we have left before we get to the best part. What's the best part we're getting to soon, Sam?
Oh, it's our wine drawing.
Wait,
Yeah.
honestly, the best part is I love that whiteboard. Look at that move. So fancy.
Yeah, it's a
I don't know. I was
scannable
impressed.
rifle.
I just love
Those
it.
who've been in the office know when
I
we do
know.
something on here, we scan it in and can print
It's so
it
great.
out.
It's so great. I
But
love it.
I just want to speak to some folks who maybe have, are visiting here or watching us later and say, hey, a lot of people that are getting close to or in retirement are wondering, worried or would like to get a second opinion on what they're doing. And say, hey, if you would like to get a second opinion, you can contact us. Amy will tell you in the end how to do that or put it into the notes. But here's kind of why. Here's kind of a way the kind of things we help people in retirement. One part of retirement is your income plan. Where's your money going to come from till now till you finally pass on, hopefully at something like 100. And we look at your income plan. If you don't have an income plan, we kind of do at least a preliminary one to see, one, will you run out of money? Or on the opposite extreme, should you be spending more because you may die with more than you intended to? So those are good information to know. Then we look at investments. And one of the things in investments is risk. And we've got fancy software we can put your current investments in and look at how much risk you're taking and judge it against how much risk you can take and how much risk you want to take. Because, if you take too much risk, it could lead to running out of money in retirement. Then we look at the position of that money. How is it, and not just for necessarily the investment side, but the tax side. Do you have diversification when it comes to taxes? Because, you need to have a tax plan. How can I arrange my money to make sure I'm not paying too much in taxes? If you're positioned wrong, you'll pay too much in taxes. If you rearrange it, you'll reduce the taxes, not so much next year, but over the next 5, 10, 15, 20 years can be important. And if you do a good job doing that, you may now be able to spend more in your retirement. So if this is of interest, give us a call and say, hey, we'd like to sit down and talk to you about this, or even just have a phone call to say, this makes sense for us to get a second opinion. So I thought I'd just pass that on as a little way to look at it. But now,
that's good.
Now we get to the good part where we want to get our drawing.
Yeah. I like it.
Yes.
I can see it's so pretty too. I love it.
Yes. So each week we raffle off 2 bottles of wine from Fermental Bottle Shop. And in order to enter, if you're on our email listserv, you just respond to the email that we send out each week, letting you know what our topic is going to be. If you're on Facebook, you just there's like a little event each week and you click, yes, I'm attending, and we'll get you on entered. And you could share either one of those with a friend and you'll get an additional entry.
You can even call me. I mean, that's even doable, but let's not get
All
crazy.
right. And our winner this week of 2 bottles of wine delivered directly to their door is Louise and Terrence S.
I didn't even do the drum roll. I'm sorry. Yay!
Yay!
Hey.
So congratulations,
Yay!
Louise and Terrence. You are our wine winners this week. Congratulations. We hope you enjoy your wine.
Yes, congratulations. We have to do a little cheers. You didn't finish it. I do want to say really quickly, I know that we had talked about it, but mentioning it, we do have some tax workshops coming up, tax classes, and they're full. And I know that we wanted some people to get in, but there'll be more coming along. Is that correct, David? Is that right? Did I hear a
We have
little
more tax classes coming in what we're going to Brunswick County next month.
Yeah.
And we also have many of you I know who are listening are been clients and have probably taken our classes in the years past. And people worry if they go to a class it'll be boring, and we don't teach boring classes, So if you like to come to one of our workshops here, or better yet, tell your friends that, hey, you ought to go to this. You're going to learn a whole bunch and have a good time. tell them to contact us and we will get them into the next one. But they're probably going to fill up fast as
Right.
well. We can't hold as many in them because we put out tables and we can't put as many people in the room. So if you've got a friend especially that's interested that could benefit, tell them to get in quick, and we look forward to seeing them. So
No,
with
don't get
that,
mad. I'm sorry, and I hate to say no, but next time. So
yeah, it's been, and with COVID, we haven't done it for like 2
I
years.
know, and it's all new material, so it's going to be fun. So,
Oh,
but there'll be more. There'll be
been a
more.
lot of changes, and
Mhm. It's
so.
filled up quickly. So, yeah. But,
Well, it's been fun. I hope this was helpful.
yeah, it's good.
See you
I
next
I
week.
learned something. So, yeah. Cheers.
See you
We'll
next
see you guys
week.
next week.
Cheers.
Bye.
Bye.